We're now going to talk to Steve Marshall. So, good morning.
Morning, James.
We can hear you all right. That's fantastic. Thank you. So you've got a presentation that you kindly gave me. I think best to hand over to you for a bit and just sort of run us through what the fund is and what it's trying to do, please.
Thanks, James. And Andrew, thank you very much for that very interesting overview of the investment trust sector. There's a disclosure. I don't think we need that. People can read that at their leisure. So thank you, Andrew, for that overview of the investment trust sector. My name's Stephen Marshall. I'm chairman of Cordiant Digital Infrastructure Fund. That is a fund that was an investment trust that was set up in February 2021. So it's a fairly recent development. We've now just announced our second annual report and accounts, and I will over the next few minutes take you through the performance of this business and who we are. But prior to setting up this fund, I'm not a banker, I'm not a financier. In fact, my career has been as a multinational corporation executive, running larger and larger companies through my career, ending up as president of American Tower Corporation, listed on the New York Stock Exchange with a market capitalization of just under $100 billion US dollars, the biggest REIT in the world and the biggest telecommunication tower company in the world. And I've been in digital infrastructure now for over 25 years. So 3 years ago, Cordiant, who are a private wealth manager out of Montreal, and myself decided to work together to try and set up an investment trust that would actually give retail investors the opportunity to invest in this really quite exciting sector of digital infrastructure. And that's defined as telecommunication towers, fiber optic networks, and data centers. And we successfully launched this investment trust, as I said, in February 2021, on the back of my reputation and that of Cordiant as an institutional investor. And we've invested, we committed to investing in digital infrastructure, towers, fiber, or data centers in UK, Europe, or North America, so OECD countries, and in the middle market. So assets, primarily private, or I guess wholly private assets, where we would have control of those businesses. We would manage those businesses effectively, in order to try and drive a greater than 9% internal rate of return for investors over the medium term, and that's what we've certainly achieved in the last 2 years. In the last 12 months, we showed a 10% total return, which drove the net asset value per share to 113.4 pence, having listed, of course, at 100p. So good growth in the net asset value per share, and that's despite increasing our discount rate, our weighted average cost of capital, by 81 basis points, primarily based on a read across from comparables in terms of increase in debt rates, increase in beta risk, etc. So despite increasing the discount rate, we were still able to further increase the net asset value of the shares. We set out in the prospectus that we wanted to not only invest in digital infrastructure, but we wanted to invest in a way which was pursuing a buy, build, and grow strategy. So not coupon clipping, taking all of the yield out of the investments that we make and passing that back to shareholders, but rather passing back, a reasonable yield, and then reinvesting remaining cash flows in organic growth within the operating businesses, maybe small bolt-on acquisitions, and indeed, as we raise more equity, potentially more larger assets that would add to wider portfolio diversification. So in the prospectus, we said in year 1 we would pay 1p dividend, in year 2 we would pay 2p dividend. But actually in year 2, because of the quality assets that we were able to secure, the board did actually commit to paying a 4p dividend in the second year, We paid 3p in the first year, 4p in the second year, so well ahead of expectations, and in line with what we're trying to achieve, which is sort of under promise and somewhat over deliver. And within our short window of operations, we've been able to primarily do that. And the dividend of 4p is well covered. The normal metric you might see is it's covered by EBITDA. In our instance, it would be covered 3.4 times by EBITDA. But if you take away from EBITDA interest costs, which obviously you have to pay if you've got debt in the business, operating expenses, you get to an adjusted funds from operation, which is really pure cash flow that's coming out of the business, and that pure cash flow would cover the dividend 1.5 times. So very, very well covered. And you can see there on the right hand side of this particular slide, we are aiming to beat that target return of 9%. We've got 10% in the last year, and we've got 21.1% since inception of this particular fund. So good progress. If we move to the next slide. This gives you an idea of just how the fund has evolved over the last 2 years. In February, we made an initial raise of £380 million. We quickly came out having found CRA, which is a big multi-asset tower, fiber, and data center portfolio, national champion in the Czech Republic. Having acquired that, we came out with a further raise, and ultimately a third raise, and raised a total of £800 million over the 3 raises. Because we acquired CRA, really great performing asset, we were able to offer that 3p dividend. Then in January 2022, we reached agreement to acquire Hudson Interexchange, which is a data center business at 60 Hudson in Manhattan. And 60 Hudson is probably the most interconnected building in the world. And people want to access, data center facilities in that building because they want to connect to, a subsector of the 300 other people that have their servers in that building. So we acquired that at very, very advantageous terms. We then increased the dividend to 4p on the basis that we had reached agreement to buy Emitel, another really strong cash flow generating business, again with large towers that support the national broadcasters in Poland, smaller towers that support the mobile operators in Poland, and certain fiber connectivity assets that can provide sort of service and support to both of those customers and government entities. We raised a couple of €100 million of Eurobond to add to our funding capability, so that we could add further diversified assets to the portfolio. And very recently, in the last 6 weeks, we notified the market that we'd acquired American Towers business in Poland, which was a fairly small portfolio of telecommunication towers. We still have £250 million of liquidity. Some of it is held on the OpCo balance sheet, some of it is held at the HoldCo, and that is available to spend on further diversification of the portfolio. If we move to the next slide, this across all of the 3 assets gives you an indication of the level of diversification of the asset mix. And we own these companies, all of these companies outright, but across the companies, there are over 1,200 telecommunication towers. There are 60 very, very tall towers that are used to service and support the primary broadcasters in both Poland and the Czech Republic. The equivalent of the Polish and the Czech equivalent of the BBC, ITV, Channel 4, Sky, some international broadcasters that are making their content available within these countries. We have a number of data center, particularly data centers that support edge data facilities, and you're going to hear a lot more about edge data facilities over the next decade. I guess many of you have heard of hyperscalers. They're remote to the end user quite often. You have fiber optic cable that allows you to access data in those facilities, but they are environmentally really quite challenged. And therefore, what's happening and what will increasingly happen is we will start to hold topical data very close to the end customer. And we own a number of smaller data centers close to the population centers that can be tethered to hyperscalers, and that is quite a rapidly emerging data center opportunity. We have over 4,000 kilometers of fiber optic networks that supports broadcast and mobile operators. We have tens of thousands of Internet of Things sensors, and I guess the best way to describe that is probably your water, gas, electricity meters. Many of you, I'm sure, will have smart meters that can be read remotely by the utility companies. Nobody has to come and knock on your door now to check the reading, and those are actually read over an Internet of Things network. So we have those networks in Poland and Czech Republic. We're increasingly providing access to the utility companies to read meters, but also all sorts of other sensors that you might find that are deployed in smart cities for environmental monitoring, weather monitoring, etc., can all sort of work across an IoT network. So, a new emerging, growing proposition on both of those national networks. We will move to the next slide. I can say a little bit more about each of the wholly owned investments that we have. Emitel in Poland is our biggest investment. As I've said before, it is a national champion. It is the #1 provider of this type of infrastructure across Poland. It's seen as critical infrastructure, absolutely crucial for the broadcasters to be able to deliver their signal, the broadcast channels to the population. CRA, the same, national champion again in the Czech Republic, providing infrastructure for the broadcasters, and both of these providing infrastructure to mobile operators to deliver the mobile network service. Both of these companies have good, solid growth opportunities. They can build more mid-sized towers in order to support the mobile operators where they don't have coverage for the mobile service, or where they need to install antennas because they don't have enough capacity. And we all suffer from that in the UK. We have a very flimsy network here in the UK, difficult to access data sometimes. The speed of download of data is poor sometimes, and that's due to lack of capacity on the network. So very much a growing market for both of these businesses as mobile operators find more cash to put more antennas onto this infrastructure to add more capacity and to provide better support for customers. And these two economies, Emitel in Poland and CRA in the Czech Republic, doing better in many respects than perhaps some of the Western European economies. If you look at the Czech Republic, GDP growth last year was 2.5%, and we see that Germany is in technical recession at the moment. So driven by much better inward foreign direct investments, good growth in operations in these countries, and Poland, a wall of cash going into Poland in support of the refugee crisis. Monies and investment going into Poland to add further security to our forward base, I guess, against for NATO. So good, really growth economies and great sectors in terms of digital infrastructure, with the wind at our backs, with everybody wanting more capacity for digital infrastructure. And finally, Hudson Interexchange in Manhattan, in New York. That is a growth opportunity. It's not cash generating at the moment, but as we lease up the floors, as big corporates, banks, media companies, Google, Facebook, want access to that facility to co-locate and have low latency connections to all sorts of other banks and media companies. we will see good growth from that particular asset over the next few years. So if we go to the next slide, what I'm trying to show here is digital infrastructure is very much a growth business. It's almost intuitive. I'm sure many of you will recognize that you are taking more and more demand off the network, whether it's over your mobile network or whether it's downloading through your laptops with your fiber optic connections. And as a result, digital infrastructure investment is probably the third largest sector for investment today. And certainly historically, we've seen the demand for more and more capacity growing at 30-40% a year for many years. And okay, this graph stops at 2022, but there are there's a number of pundits out there forecasting that demand across the network, because of just general usage, more applications, AI now coming into the forefront, will drive even more demand for data center capacity, even more demand across mobile telecom networks and fiber optic cables, and more demand for physical infrastructure for antennas on towers. So very much wind at the back, growing at a double-digit rate, which is very helpful if you're in that business. If we go to the next slide, I would just sum up by saying that despite it only being in existence for a couple of years, I think the thesis is really playing out now. The assets that we've acquired are operating extremely well. These are very, very important assets in the countries in which they operate, and they're driving very, very good growth, very, very good EBITDA, very good cash flows. 10% return over the last year, 21% return over the last 2 years, beating that 9% target hurdle rate that we set out in the prospectus. Dividend well covered, a very diversified portfolio mix, and I know that people in investment trusts would like to see multiple different legal entities. We have 3 actually across these assets, but within those legal entities there is a massive diversification of assets, some of which could be sold off, either one or a portfolio of towers or fiber optics or the data centers. So there is a high level of diversification if we wish to pursue that, the sale of any of those assets. Strong liquidity, opportunities to drive this thesis of buy, build and grow, buy good assets with good management teams, encourage them to invest in organic growth, encourage them to invest in bolt-on acquisitions, yet still have enough cash to pay a dividend for the investment trust sector. And with that 250 million of cash that we have today, we do have 2 really good opportunities that are actually today under exclusivity that we're now undertaking confirmatory due diligence on, and in reality we could choose to close on one or both of those in the next sort of couple of months to further diversify the asset base. And those 2 assets under exclusivity are Western Europe, and they are in, I guess, different segments of digital infrastructure than the assets that we have in Poland and the Czech Republic. So with that, James, I'm certainly happy to try and answer any questions that listeners might have.
Thank you very much, Steve. That's quite a good rundown. Let's start with the most sort of recent returns then. So you got a decent uplift, as you say, in the NAV this year. What drove that?
Yeah, the operating performance of the businesses primarily drove that. As we grow cash flow, we reduce the debt, which grows the equity value. We did have some beneficial improvements as a result of forex gain, the pound a little weaker than the overseas currencies, and those are the two primary drivers of the growth in the NAV.
Okay, thank you. The question here just asking what sort of organic growth rate of the underlying portfolio is.
Organic growth rate is very much as we see there, 10%, 21%. There is investment, I guess, in organic growth. There is a little bit of investment in building new towers, which would require more cash, I guess, or take cash from the available cash for yield. But it's a fairly small part of the process, and you're not paying an acquisition premium. We've made one bolt-on acquisition when we acquired American Tower's assets. So that's a little bit of a premium there for that portfolio, but not a lot. It was a very well negotiated, good deal. It was American Tower tidying up their operating portfolio across Europe. So primarily, organic growth is what you see here in the 10% or the 21% since inception.
So you talked about a sort of 254 million cash pile to spend on new opportunities. Well, if you did spend that, would that be you fully invested, or could you? There's still more debt you could add to the structure?
Yeah, that's the available cash at the moment. About 90 million of that cash is on the balance sheets of the OpCo. The rest of it's at HoldCo. We could invest that in the two assets. We would spend most of that cash if we did that. Both of the assets that we're looking at are both EBITDA positive and growing assets. We are at about 37% debt to gross asset value. We are allowed we've signaled certainly in the prospectus we won't go over 50%. So we do have the opportunity to add probably another couple of 100 million of debt if we chose to do so. We've generally tried to follow a conservative gearing formula. We wouldn't, I think, ordinarily look to increase that debt any further unless we had a very, very good investment opportunity ahead of us. Like most investment trusts, certainly the intention has always been that as we grow the business, we go out for more equity from shareholders. Until the recent discount to the sector. Certainly, we had probably about four very significant wealth investors in our stock that were capped out at 10% of our stock, and were certainly encouraging me to go out and buy some more assets so that they could increase their investment in the business. As Andrew's pointed out, there's a bit of a discount now, so historically people have not raised equity whilst they're in a discount. So we'll have to see how that sort of evolves, James, over the next 6-12 months.
Yeah, hopefully things will settle down and you'll be able to come back to market again, but we'll see how we go. When you're buying these things, what's the sort of average multiple of revenue that you're paying for them, or multiple of earnings? Sorry. So the EV/EBITDA is the question.
Yeah. Now we, as we set out in the prospectus, we very much want to invest in the middle market sector. So I would define that within digital infrastructure as assets probably worth less than €1 billion, $1 billion, anywhere between sort of 100 million and $1 billion would be mid-market, and that's somewhat differentiated from the big trophy assets that you might have seen in the press. People buy. My old company, American Tower, bought Telsius's European mobile tower business from Telefonica. They paid, I don't know, 5-6 billion euros for that at a pretty racy multiple, probably 28 times EBITDA. Digital Bridge with Partners bought Deutsche Funkturm last year at probably 29 times EBITDA. Again, probably 5 or 6 billion. I forget the exact number. So trophy assets, which are of interest to the big boys, that have a lot of cash to deploy, you know, the KKRs, the Digital Bridges, the Brookfields, the Blackstone, you know, those sort of big funds that have a lot of cash. So those asset prices are sort of driven up to some fairly racy prices. Now, in the middle market, these big fund managers, infrastructure funds, they're not interested in the middle market, because buying something for $500 million really doesn't move the bar, and takes too much effort just to get a $500 million euro business. So it's a less crowded trade. We find ourselves competing against smaller PE companies that may be not specialist in digital infrastructure, where we only do digital infrastructure, and therefore we find that that gives us a competitive advantage. And because the bidders are not specialists, they're not bidding up the prices to the same extent. So we've been able to acquire this portfolio for less than 11 times EBITDA multiple. So you compare that with you know, Digital Bridge buying Deutsche Funktum at 28 times. There's a massive difference there. And when you think, wait a minute, Deutsche Funktum is the same asset class, the same type of assets, but it's bigger and it's across Germany, as Emitel in Poland, exactly the same asset class. And one across Germany is costing 28 times, and the one across Poland we actually secured it for that particular one for less than 10 times. So very, and it probably displays higher growth trajectories than that in Germany. So middle market gives you the opportunity, and certainly we've now proven that, you know, provides the opportunity to buy really good quality assets that are national champions in their own geographies at fairly attractive propositions.
Emitel and CRA are the sort of number ones, as you said, there in their markets. How important is it that you are the sort of dominant player in these things?
I think it's absolutely crucial. I mean, you know, if you're a broadcaster, or if you are a Discovery Channel and you want to access the Polish population, bring your content to the Polish population, which of course international broadcasters do, then they would go to Emitel. There is only Emitel that can provide the infrastructure in order for them to be able to do that. So it's you know, it's a business with a very strong competitive moat. You know, nobody else can provide that, and it's got nationwide infrastructure, so it's an important provider of infrastructure to the mobile operators. You know, if they want coverage in a particular area, and Emitel has a tower there, they really have to go on Emitel's tower. You know, nobody will give them planning permission to build a separate tower and use a separate tower if Emitel has already got one in the place. And this national infrastructure was built at a time when, you know, planning approvals it was a different system. You could not replicate this infrastructure anymore, right? It was built in a day when it was probably owned by government, and they had permitted you know, development rights, and now it's in the private domain. But you could never replicate it. So these are extremely strong cash flow generating businesses. If you look at Emitel and CRA, they provide this national infrastructure to the broadcasters and to the mobile operators. The cost of installing equipment on the towers that we own is obviously expensive, and therefore, you know, T-Mobile does not want to install equipment on our towers, and then we tell them that they have to take it off in a year because we've got somebody else who would pay some more. So they want to sign 20-year contracts with us. Because they want to sign 20-year contracts with us, we want an escalation clause in that contract, which protects us against inflation. Inflation, therefore, is usually quite beneficial for us. It drives up our revenues faster than if it was not inflation. But our cost base is a small part, really, of our revenues. So we're getting inflation at the top level, but the inflation on our cost base is only sort of 30% of our cost base. So inflation is usually our friend. So we have long-term contracts with escalation clauses with primarily blue chip clients, the big mobile operators, government departments that want equipment on there for security services or for public service communications, and the big broadcasters, again, the equivalents of the BBC, ITV, Channel 4. So really good quality blue chip clients. So you take those things together, long-term contracts, escalation clauses, blue chip clients, it actually starts to show you a very predictable growing revenue stream over many years to come, which creates a very attractive valuation scenario.
Yes. Do you think there's actually a portfolio effect? I mean, because you say these sorts of things, they're probably too small for the big giants, but as you assemble them into a portfolio, do you become more of a sort of bite-sized chunk?
I think that is clearly an opportunity, James, in that we at the moment we're worth give or take $1 billion. As we add to this, as we add more assets, and we become a 2 billion or a 3 billion euro business, then all of a sudden we start to become of interest to the big investors, and therefore you might actually see an increase in the valuation multiple that people would pay for that collection of assets. I guess we've done a service to the industry in bringing the assets together, creating that more critical mass, which makes it of interest to people who are willing to pay more. But we don't really bank on that. We are an investment trust. We have permanent capital. We can own these assets for a very, very long time. And if they continue to generate good growth, good cash flows, we may well hold them for a long period of time. But if we build a much bigger entity, we might find that somebody wants to pay a much higher EBITDA multiple valuation for our assets, in which case we would always do what's in the interest of shareholders.
One of your peers had a problem with losing its management team. Is there anything you can do to ensure that the same thing doesn't happen to you?
Well, I guess one of my peers, they lost the manager. I guess I am the manager of this. So, as long as I stay, we're not going to have the same issues. And to me, this is a little bit of a labor of love. It's something that I and my colleagues at Cordiant have conceived. We've had a great 2 years. We see a great future ahead of us, and we set this up to give the retail investor access to this really fantastic sector, which we've done, and there's no doubt it's going to continue to grow for many years. So I'm just looking forward to building an even bigger and bigger franchise over the next 5-6 years.
I think one of the key messages maybe to get across to people is that this is not all about yield, and it shouldn't be priced off yield. But to what extent do you think you can grow the dividend from here?
Yeah, we set out in the prospectus that we would pursue a progressive dividend policy. As I said, we didn't know what we were going to buy in the first year, so we were conservative, saying we'd probably pay 1p in the first year, 2p in the second year. We've been able to acquire good assets, good cash flow generating assets that will cover a higher dividend. So we've paid 3p in the first year, 4p in the second year. We would expect to continue to grow the dividend. But equally, we are pursuing a buy, build and grow model. So we don't just want to pay out all the cash. I mean, if we did, we could probably pay a 7p dividend or something, 7 or 8p dividend if we wanted to do that. But we see a lot more value in trying to grow the business while still giving some degree of yield to this sector, which seems to appreciate yield. Andrew was talking earlier, big discounts on some of the investment trust markets that have set themselves up as pure growth. They don't generate cash. They're investing the cash they've raised. they're not paying any dividend. Whereas, you know, we are very much trying to walk that line, provide that balance where people get a decent dividend, growing dividend, but also we're investing in growth. So we're certainly not a bond proxy. We are very much more growth orientated.
We've run out of time, which is very unfortunate because I think we could have gone on for ages. But honestly, that was really interesting. Thank you very much, Steve. That's helpful. And we will get you back again another time and follow up on the story and see where we are. Thanks very much, James. Thanks, everybody. So thank you to everybody who persevered with the logging on problems and made it here. We got a proper audience in the end. We'll be back next week talking to the manager of Henderson High Income. But in the meantime, have a great week, and I'll see you next Friday.